I want you to slow down and look at a mechanism that most people do not understand, because the people who do not understand it tend to stand on the wrong side of it. When a country has too much debt, it rarely solves the problem in the clean way people imagine. It does not usually sit down, cut every unnecessary expense, raise every necessary tax, and pay the debt down honestly in the same purchasing power that was borrowed. That is not how large debt cycles usually end. In my experience, when the debt gets too large, the system looks for a way to reduce the real burden of the debt without calling it a default. It looks for a way to pay back the same number of dollars with dollars that buy less. That is the part most people miss. They hear people say the government may quietly cancel part of its debt, and they picture something dramatic. They picture a politician making an announcement. They picture a line item on a balance sheet being erased. They picture the Federal Reserve or the Treasury openly saying that the debt will not be paid. That is not how it normally works. The debt can be paid in full in nominal terms and still be reduced in real terms. Every dollar can be delivered. Every bondholder can receive the number of dollars promised. Every mortgage payment can be made on schedule. And yet the value of those payments can be quietly diluted by inflation. That is the machine. And if you have a fixed-rate mortgage, especially one that was taken out when rates were low, the same machine that reduces the real value of the government's debt can reduce the real burden of your mortgage too. This is why the issue is not only about Washington, it is about your own balance sheet. It is about whether you are a saver being slowly drained by inflation, or a borrower with fixed-rate debt tied to a real asset whose income and asset value can rise with the nominal economy. There is a very big difference between those two positions. In one position, you think you are safe because the number in your account does not move. But the purchasing power behind that number leaks away year after year. In the other position, you owe the same number of dollars every month, but the dollars themselves become easier to earn, easier to repay, and less valuable to the lender. That is why the next phase of policy matters so much. People will debate personalities. They will debate the new Federal Reserve chair. They will argue over whether one person will cut rates aggressively or not. They will attach the whole story to a name, a date, and a political fight. That is not how I think about it. I think about incentives, I think about constraints, I think about the mechanics of the system. The United States has an enormous debt burden. It is not only the size of the debt that matters, it is the cost of rolling it over. Every year, a large portion of that debt matures and has to be refinanced at the rates available in the market. When rates are low, the pressure is manageable. When rates are high, the cost becomes a major part of the federal budget. That is the same thing that would happen if your own mortgage reset every year. If your payment changed every 12 months based on the market rate, you would not think only about the balance. You would think about the rate, you would think about the payment, you would think about how quickly your financial situation could change if the refinancing environment turned against you. That is what happens to a government that funds itself with constantly rolling debt. Interest expense starts to crowd out everything else. It does not build a bridge, it does not defend a border. It does not educate a child, it does not provide medical care. It is the cost of yesterday's promises. Once interest becomes one of the fastest growing expenses in the system has a problem that cannot be fixed with slogans. The usual solutions sound simple, but the math is not simple. You can say, raise taxes. But raising enough taxes to solve a debt problem of that scale would create political and economic consequences that almost no elected government wants to face. You can say, cut spending, but the biggest spending categories are usually the most politically protected categories. They include retirement programs, healthcare promises, defense commitments, and interest itself. Cutting them enough to solve the problem would be politically explosive. You can say, grow out of it. That is the healthiest path when it is possible. If the economy grows faster than the debt becomes smaller relative to income. But when debt, interest, costs, and obligations are already rising quickly, growth alone usually cannot carry the full weight unless productivity rises dramatically. So the system turns to the path it has used before: financial repression. That phrase sounds technical, but the idea is simple. The government and central bank keep the return on safe savings below the rate at which money loses purchasing power. They may not always say it that way. They may describe it as supporting employment, stabilizing markets, avoiding a debt spiral, protecting the banking system, or managing a transition. But the effect is the same. Inflation runs higher than the yield savers receive. The real value of cash and low-yielding fixed income falls. The real value of debts fixed in nominal dollars also falls. The burden is transferred from debtors to savers. That is why I like to think of the dollar as a battery. A dollar has a number printed on it, but the number is not the real thing. The real thing is the charge inside the battery, the purchasing power. A dollar with a high charge buys more, a dollar with a low charge buys less. Inflation drains that charge. The battery does not become smaller. The label still says $1. Your account still says $100,000. Your mortgage still says $300,000. The numbers remain recognizable, but the charge changes. When the charge leaks out of the dollar, the saver loses power. The borrower who owes fixed dollars benefits, because the debt is repaid with weaker batteries. If you borrowed fresh batteries and you repay with drained batteries, you have been helped by inflation. If you saved fresh batteries and held them while they drained, you have been taxed without a vote. That is the essence of financial repression. It is not a conspiracy. It is not a secret room. It is not a story about one man controlling everything. It is a policy response that becomes attractive when debt is too large and default is too dangerous. The United States has used this playbook before. After World War II, the debt to GDP ratio was extremely high. The country had borrowed heavily to finance the war. If you looked only at the debt burden, it was alarming. But over the following decades, the debt ratio fell dramatically. That did not happen because the government simply paid down the debt in the way a household pays down a credit card. It happened because nominal growth, inflation, and controlled interest rates worked together. The government paid what it owed, but it paid in dollars that became less powerful over time. Savers and holders of low-yielding fixed income absorbed much of the cost. People who owned scarce assets, businesses, real estate, and productive property generally did better. People who held too much cash or low-yielding fixed income because they thought it was safe often did worse in real terms. This is the part that matters for the person with a mortgage. If you have a long-term fixed-rate mortgage, your payment does not rise with inflation. Your principal balance is fixed in nominal dollars. The lender receives a set stream of payments. If inflation rises and wages, rents, and nominal asset values rise over time, that fixed payment becomes easier for you to carry. The house is a real asset. The mortgage is a nominal liability. That combination can be powerful in an inflationary or financially repressive environment. You own the asset that can reprice. You owe the debt that does not reprice. If you bought a home with a 3% or 3.25% fixed-rate mortgage, the value of that loan changed when the world changed. When market rates moved higher and inflation remained persistent, your old low fixed rate became more valuable. It became an asset disguised as a liability. That is difficult for many people to understand because they were raised with a simple rule: debt is bad, pay it off as quickly as possible. That rule is often emotionally satisfying. It reduces stress. It gives people a sense of control. It may make sense in many environments, especially with high-interest consumer debt or when the interest rate on the debt is expensive. But good principles require context. A fixed-rate mortgage at a low rate in an inflationary environment is not the same as a credit card balance at 20%. One is a claim against your future purchasing power at a fixed low cost. The other is a compounding drain, treating them as the same thing as a mistake. A low fixed-rate mortgage can be one of the strongest positions a household has during a period when the system is trying to reduce debt burdens through inflation. That does not mean debt should be used recklessly. It does not mean everyone should borrow as much as possible. It does not mean you should ignore risk, cash flow, employment, or personal circumstances. It means you should understand the difference between bad debt and strategic fixed-rate debt tied to a productive or useful real asset. The mortgage payment remains the same. Your income may rise over time. Your business revenue may rise if you own a business and can adjust prices. Your wages may rise, even if imperfectly, through cost of living adjustments or labor market pressure. Your rental income may rise if you own rental property. Your house may be priced in nominal dollars that move upward as the currency loses value. The payment does not care. It stays fixed. That gap is the quiet mortgage bailout. It is not a check from the government. It is not a forgiveness letter from the bank. It is not a line being deleted from your mortgage portal. It is the real weight of the payment shrinking while the nominal number stays the same. This is what people often fail to see because they look at nominal dollars instead of real purchasing power. They say, I still owe $300,000. But the better question is, what does $300,000 mean 10 years from now if incomes, rents, groceries, insurance, wages, and replacement costs are all much higher? The number is the same, the charge in the battery is not. That is why accelerating a low fixed-rate mortgage can be a very expensive form of emotional comfort. If you send extra principal to the bank, you are returning valuable present dollars to remove a liability that might become easier to carry over time. You are giving the lender stronger dollars today instead of letting inflation help you pay them back with weaker dollars tomorrow. There are times when paying down a mortgage makes sense. If your rate is high, if your cash flow is fragile, if your personal risk tolerance requires it, if you need the psychological freedom, or if your alternatives are poor, then the decision may be different. But if your mortgage rate is far below the likely inflation and nominal income growth path, you have to think very carefully before handing that advantage back. The bank understands this. The market understands this. The loan has economic value because it is fixed at a low rate while the world around it has repriced. The question is whether you understand it. There is another side to the same mechanism, and it is the side that hurts savers. Financial repression requires someone to lose purchasing power. Debt cannot be made lighter in real terms without the other side receiving money that is worth less. If the government reduces its debt burden through inflation, bondholders lose in real terms. If banks pay savers less than inflation, savers lose in real terms. If people hold cash because they feel safe, they are often being drained by the system while feeling responsible. That is why a savings account can be dangerous when people misunderstand it. A savings account provides nominal stability. The number does not swing like a stock price. There is psychological comfort in that. But if inflation is running above the rate you are earning, the account is losing real value. It is a quiet loss. Quiet losses are often more dangerous than loud losses because people do not react to them. A stock market decline frightens people because it is visible. A cash account losing purchasing power does not look like a loss on the statement. The number is still there. The battery has simply drained. A saver can look safe and be getting poorer. That is one of the most important lessons in a debt cycle. The system does not need to take your dollars to reduce your wealth. It only needs to reduce what your dollars can buy. That is why the saver with cash at a very low rate can become the person funding the debt adjustment. The saver thinks, I am avoiding risk, but they are only avoiding price volatility. They are not avoiding purchasing power risk. Those are different risks. The financial industry often confuses people by treating volatility as the only risk that matters. But in a world where governments have large debts and central banks have incentives to tolerate inflation, the bigger risk for many people is not a temporary market decline. It is permanent loss of purchasing power. If you want to understand what to do, do not start with products. Start with principles. The first principle is that you must measure wealth in purchasing power, not account balances. If your account grows from $100,000 to $105,000, but the cost of the things you need rises faster, you did not become richer. You became poor in a way your statement hid from you. If your house, business, or productive asset rises in nominal value while your fixed debt becomes easier to service, you may be improving your position even though the debt balance still looks large. The unit of measurement matters. In periods of financial repression, dollars are not a stable measuring rod. They are part of the thing being manipulated. That is why a person who wants to be rational must learn to think in real terms. What is my income in real terms? What is my debt burden in real terms? What is my cash earning after inflation? What assets do I own that can reprice with the nominal economy? What liabilities do I owe that are fixed in weakening dollars? These questions matter more than the comforting question of whether the number in your bank account is bigger than last year. The second principle is that you must understand what kind of asset benefits when money is being diluted. Assets that are scarce, productive, or able to pass through inflation tend to have an advantage. High-quality companies with pricing power can raise prices when costs rise. They can protect margins better than weak companies. They can convert inflation into higher nominal revenues. Real estate can benefit if replacement costs, rents, and nominal wages rise, especially when financed with fixed-rate debt. The asset can float upward with the nominal economy while the debt remains fixed. Hard assets, including precious metals and other scarce physical assets, can serve as stores of value when confidence in paper currency weakens. Cash flow producing assets matter because they do not merely sit there hoping for someone else to pay more. They generate income that can adjust over time. This is why the broad idea is not to chase hype. It is to hold assets that survive and adapt when the currency is being drained. The third principle is that you must identify the traps. The first trap is long-duration, low-yield debt owned by you as the lender. If you lock up money for many years at a rate that fails to compensate you for inflation, you may be guaranteeing a real loss. The payment arrives, the math looks safe, but the purchasing power may be destroyed. The second trap is excess cash held only because the world feels uncertain. Uncertainty is real, and everyone needs liquidity. But there is a difference between having an emergency reserve and holding a large portion of your wealth in cash because you are afraid to make decisions. Fear can feel like prudence, but if the system is designed to drain cash through inflation, fear becomes expensive. The third trap is concentration. People hear one idea and then go all in. They go all in on real estate, all in on gold, all in on technology, all in on cash, all in on crypto, or all in on one country. That is not strategy. That is emotional certainty pretending to be conviction. Good investing is not about finding one magic asset. It is about building a balanced system that can survive different environments. If inflation stays higher than expected, you want assets that can protect you. If deflation or recession hits, you need liquidity and resilience. If rates fall, certain assets may reprice. If rates stay high, weak borrowers will suffer. The future is not one path. It is a range of probabilities. That is why I think in terms of balance. The source of the opportunity in a low fixed rate mortgage is not that debt is always good. It is that this particular debt has characteristics that can work in your favor under this particular policy environment. A mortgage at 3% fixed for 30 years is very different from a floating rate loan, a credit card, or a speculative margin loan. The term matters, the rate matters, the asset matters, the cash flow matters. People who speak in simple slogans usually miss these distinctions. Now let me make the practical part clear. If you have a mortgage, look at the amortization schedule. See what you owe. See what your interest rate is. See how the payment behaves over the next 10 and 20 years. Do not make emotional decisions about extra principal payments without understanding the real value of the fixed rate you already possess. If your mortgage rate is below the rate at which inflation and nominal income are likely to compound over time, the debt may be working for you, not against you. That does not mean you ignore it. It means you manage it intelligently. If you are holding cash, compare your yield to inflation. Do not ask only, am I earning interest? Ask, am I preserving purchasing power? A large bank paying almost nothing on savings is effectively using your money while you absorb the loss in real terms. Moving idle cash to a higher yielding account may not solve every problem, but it can reduce the degree to which you are being drained. If you have equity trapped in a home, understand what that equity is. Equity is stored purchasing power inside a real asset. Sometimes keeping it there is wise. Sometimes accessing it carefully can make sense. Sometimes it creates dangerous leverage. The answer depends on the use. Using home equity to speculate is dangerous. Using it to buy cash-flowing assets, reduce high-interest debt, or strengthen a balance sheet can be different. But the key is this: never pull equity simply because it is available. Pulling equity is only intelligent when the destination of the capital is stronger than the source and when the cash flow can withstand bad conditions. A HELOC, a cash-out refinance, or a reverse mortgage can each be useful in the right setting and destructive in the wrong setting. The instrument is not good or bad by itself. The context makes it good or bad. That is how I think about nearly every financial decision. No tool is safe in the hands of a person who does not understand it. No tool is dangerous in every situation. The question is whether the tool fits the environment, the balance sheet, the cash flow, and the person's behavior. Behavior matters enormously. Many people will hear that a fixed mortgage is valuable and use that as an excuse to borrow more than they can handle. That is not the principle. The principle is to understand the asymmetric position created by fixed debt during inflation. It is not a license to be reckless. Others will hear that cash loses value and put every dollar into volatile assets. That is also not the principle. The principle is to hold enough liquidity to survive, but not so much idle cash that inflation becomes your largest expense. Balance is the point. Let me bring it back to the bigger system. When governments are over-indebted, they tend to choose policies that make debt easier to carry. They may not say it directly, they may frame it in other terms. But the effect is often the same. The currency is allowed to lose value gradually, while rates remain managed, and debt burdens shrink in real terms. This helps borrowers. It hurts savers. It benefits owners of scarce and productive assets. It punishes people who confuse nominal safety with real safety. This is not a moral statement. It is a mechanical statement. The machine does not care whether you think it is fair. The machine does not care whether you worked hard. The machine does not care whether you followed the rules your parents taught you. If the environment changes and the rules you follow no longer match the environment, you can be punished for being obedient to an old world. That is one of the hardest lessons in money. Principles must be timeless, but tactics must adapt. A timeless principle is to avoid destructive debt. A tactical mistake is to treat every fixed low-rate mortgage as destructive debt during a period when inflation is reducing the value of nominal liabilities. A timeless principle is to keep liquidity. A tactical mistake is to hold too much cash at a yield below inflation because volatility scares you. A timeless principle is to diversify. A tactical mistake is to diversify only across accounts or managers while all of the assets are exposed to the same inflation risk. A timeless principle is to think independently. A tactical mistake is to wait for a banker, a news anchor, or a politician to tell you when the shift has happened. By the time they tell you, the shift is usually already reflected in prices. The people who do well in these transitions are not necessarily the people with the highest IQ. They are the people who understand the machine early enough to adjust with discipline. They do not panic. They do not chase every headline. They do not worship cash because it looks stable. They do not worship debt because it can be useful. They ask a more basic question: what side of the policy is my balance sheet on? That question is powerful. If the policy is designed to reduce the real burden of debt, and you have good fixed rate debt attached to a real asset, you may be on the benefiting side. If the policy is designed to keep safe yields below inflation, and most of your wealth is in cash or low-yielding fixed claims, you may be on the paying side. If the policy is designed to support asset prices in nominal terms, and you own productive assets, you may be protected. If you do not own assets, and your savings are in dollars that lose charge every year, you may become the person who funds the adjustment. That is why this is so important. It is not about one mortgage. It is about understanding the difference between nominal thinking and real thinking. It is about seeing that the same dollar can mean different things at different points in a debt cycle. It is about knowing that inflation is not only higher prices at the grocery store, it is also a transfer mechanism between debtors and creditors, between asset owners and cash holders, between those who understand the system and those who only feel it after the fact. When people say the Fed or the government is canceling debt, the more precise statement is this: they are reducing the real value of debt by allowing the value of money to fall. That is not as dramatic as a headline, but it is far more important. Because if you understand it, you can look at your own life differently. You can look at your mortgage differently. You can look at your savings account differently. You can look at your home equity differently. You can look at your investment portfolio differently. And most importantly, you can stop reacting emotionally to a system that is operating mechanically. There are two roads from here. One road is the road most people take. They keep doing what they were taught without asking whether the environment has changed. They accelerate a low-rate mortgage because debt feels bad. They keep too much money in a low-yielding account because cash feels safe. They ignore purchasing power because the nominal balance looks stable. They wait for someone official to explain the change after the advantage has already moved away from them. That road feels responsible. But in a financial repression environment, it can be the road that slowly transfers wealth from the household to the system. The other road is harder because it requires thinking. It requires pulling your own numbers. It requires reading your amortization schedule. It requires comparing your savings yield to inflation. It requires understanding what your home equity is doing. It requires holding assets that can adapt while keeping enough liquidity to survive stress. It requires refusing both panic and passivity. That road is not exciting. It is not a get-rich-quick story. It is not a fantasy about the government erasing your mortgage. It is simply the disciplined recognition that the same policy forces that help an over-indebted government can also help a household with the right kind of debt and hurt a household with the wrong kind of savings. This is why I keep coming back to principles. Know what you own. Know what you owe. Know whether your assets reprice. Know whether your liabilities are fixed. Know whether your income can adjust. Know whether your cash is actually preserving purchasing power. Know whether your decisions are based on current reality or old rules from a different cycle. If you do that, you do not need to predict every Fed meeting. You do not need to know the exact day rates move. You do not need to know whether one person will say one phrase in one testimony. You need to understand the direction of the machine and where you stand in relation to it. The debt problem is not going away. The pressure to reduce the real value of that debt is not going away. The temptation to let inflation do part of the work is not going away. And the quiet transfer from savers to borrowers, from cash holders to asset owners, from nominal thinkers to real thinkers is not going away. The only question is whether you will recognize it while you can still adjust. Because doing nothing is also a decision. Holding cash at a bad rate is a decision. Paying extra principal on a very low fixed mortgage is a decision. Ignoring your home equity is a decision. Owning no productive assets is a decision. Waiting for the news to make the system clear is a decision. The machine keeps running either way. It runs whether you understand it or not. It runs whether you agree with it or not. It runs whether you feel ready or not. The people who get hurt most are often not the irresponsible people. Many times, they are the disciplined people using the wrong map. They save carefully. They avoid all debt. They keep money in familiar banks. They follow advice built for a world where interest rates, inflation, asset prices, and government debt looked very different. Then the world changes, and their habits turn against them. I do not want that to happen to you. So do the simple work. Look at your mortgage rate. Look at the term. Look at the amortization. Look at your savings yield. Look at inflation. Look at your equity. Look at where your capital sits. Look at whether it is being drained or whether it is positioned to hold charge. Then make decisions based on the machine, not based on slogans. That is how you move from being the battery they drain to owning the assets that can keep charging. That is how you stop thinking like a victim of the debt cycle and start thinking like someone who understands how debt cycles work. And once you understand that, you will never look at your mortgage, your savings account, or the dollar in the same way again.